As traders, volume is one of the key pieces of information that we get from the markets. Everyone's familiar with the prices that we see in the markets and what price movements are showing us, but volume gives us more of an insight into what was behind those movements. In basic terms, volume represents the amount of the asset that's been traded. So it's showing us the level of activity in the market, which relates to the number of actual transactions going through. So for example, if we're looking at an individual company, an equity, and we're seeing the volume over the past hour, if 1,000 shares were traded during that time, the volume would be 1,000. Now there are two main ways that we see this being displayed on the charts. The most common way is volume by time, which is often represented by these bars along the bottom of the price chart. But another very useful way is volume by price, which shows what volume was transacted at different price levels. There are also other ways to look at volume in the markets, including some very complex methods in specialized trading platforms. But for the most part, volume by time and volume by price will do the job and give you the information that you need if you're just a private trader. Different markets, different assets will have different average levels of volume. So if we're looking at something like a major currency, we'd expect massive daily trading volumes, whereas smaller assets like low value stocks might not have much daily trading volume at all. And in fact, even in a particular asset, these levels can fluctuate all the time. There'll be different times of the day when it's higher than others, and different times of the year. There might be things going on that leads to higher volume than at other times. The amount of volume in a market will contribute to how volatile the price movements are. Typically, in markets with higher volume on a regular basis, you'll see much more free-flowing price moves than markets with low amounts of volume. However, when there's low volume in a market, it's much more susceptible to sudden erratic price movements if large transactions or a large quantity of transactions hit the market at the same time or around the same time. This might happen when something takes place that changes the fundamental value of the asset, such as an economic event or earnings release, things like that. But something to keep in mind, which traders often overlook, is that volume is only one half of the equation. How volatile the price movements are will also depend on the level of liquidity in the markets. So if a market has high volume, we might not get such big price moves if there's also high liquidity. But if there's low liquidity, we'd expect the price to move quite a lot if there's also high volume. Another important thing to keep in mind is that some markets are decentralized, like currency markets. So in those cases, the volume that you'll see is likely to be only the volume for that specific broker or their partners, rather than for the whole market. However, this can still be useful as long as you look at the volume in relative terms rather than absolute terms. So that means you're comparing the volume that you see to previous volume from that same broker, that same market, rather than taking any individual volume bar as a standalone measure. In some cases, the volume will also be based on tick data instead. So rather than actually displaying the volume of the asset that's being traded, it's making an assumption about the number of transactions that have been made based on the number of times the price has moved a tick. So it's assuming that a price move of a tick is a transaction going through. Now, volume can be really helpful in many ways. One example is for validating the price moves that we see. So for example, if we have two similar price moves that we're comparing, but one was achieved with low volume and the other had higher volume, that tells us something about the dynamics of the market. So a question we can ask ourselves is whether the price move happened with an appropriate level of volume or whether there seems to be some sort of anomaly that signals something else to us. We can also use volume to determine price levels where we'd expect a path of resistance or a smoother flowing move through it. And there are many other things as well, and of course many more details to the things I just described. And if you want to start getting into more of these details, check out the description box below for more free resources to help fast track your trading development. Thanks for watching.